It is my pleasure to welcome each and every one of you to this General Counsel Roundtable on behalf of the fourth floor. And today our topic is Crypto Curious. What do you need to know as a GC? And the goal with this discussion today is really to have a candid conversation about how General Counsel can best navigate what essentially is a brave new world. We're going to hear from our panel of experienced GCs and outside counsel about the challenges and the opportunities that crypto presents to businesses, and then by extension, their in-house legal functions. We do have a lot of RSVPs, so we anticipate this could become a very full house today. So as I've now mentioned a few times, keeping yourself muted would really help us out. Also, get your questions ready. If and when you have a question, you want to put it in the chat. If you can put a Q and then a colon, will help us quickly find the questions. We will do our best to allocate time at the end of the discussion for questions, so don't be shy. However, we can't guarantee, we'll get to the number that we can. And Lisa, as I mentioned, will be standing by to assist with questions at the end if it becomes useful. Before we dive into the discussion, I just want to say a brief word about the fourth floor. What we do at the fourth floor is hack the system. We incentivize companies of all sizes to list advisor, director, and observer opportunities on our digital board seat exchange. We then aggregate those opportunities and we make them available to women, especially lawyers, although not just lawyers, so that those women can initiate and advance their for-profit board careers, they can earn equity and invest. And one way that they can do this is by tapping into the under-leveraged value of women entrepreneurs in particular. We help women founders access funding and growth opportunities in our Backroom Investment Club. So that's also available then to our board candidate members. So if you are not a member of the fourth floor, but you are interested in advancing your board career or investing in a woman-led startup or fund, then consider joining us as a member and or sign up for a platform tour to learn more. We do them every Mondays at 2 o'clock. We also do something called Board Bootcamp, which is a great introduction to all that we're about. The next one is September 14th from noon until 2. So we're going to drop the links in the chat so you can sign up for a platform tour, apply to be a member, come to Board Bootcamp. And then finally, if you love the idea of everything I'm saying, but you do not want to pay a membership fee, we are happy to help you convince your employer for your employer to list on our board seat exchange and then underwrite your candidate nomination. So if that is interesting to you, please ask us about the Pay It Forward initiative. Finally, last announcement is just that we do have another great event coming up on June 28th from noon to 1. It will provide a layperson's explanation of the securities laws that apply when a business is considering a raise, which I think could be very useful to founders and practitioners alike, depending on your subject matter expertise. So, please feel free to join us. It is free and open to the public. All of those links will be in the chat. Okay, so enough about me and the fourth floor. We want to get to the point of today, which is crypto. We have a lot to talk about. It is my absolute pleasure to introduce our amazing panelists. I'm going to start with Lisa Anastos, Chief Legal Officer and Chief Strategy Officer of IdeaQuest. She will actually be your fearless moderator today, and she will in turn introduce the other panelists. So actually at this point, Lisa, let me hand the stage over to you to introduce your other panelists who you will be moderating, and yourself, of course. So please take it away.
Well, thank you so much. And thank you, Flora, for inviting Glynna, Debra, and I to come speak on a topic we're all extremely passionate about, and it is all over the news. So my name is Lisa Anastos. I'm the Chief Legal Officer and Chief Strategy Officer of IdeaQuest. IdeaQuest is a marketing boutique that specializes in sports, where cryptocurrency companies have poured billions of dollars into sports sponsorships in 2021 alone. Glynna, I will turn it to you.
Sure, Glynna Christian. I am the head of global tech transactions at Holland & Knight. I'm actually based here in Chicago, and like other firms, we have a lot of clients that are busy in the crypto space and other digital assets. And the firm itself is busy with NFTs and doing some innovative technology in the space too. Deb.
Hi, my name is Debra Noll. I am the General Counsel at Wire. Wire is basically an infrastructure provider. We enable developers to build cryptocurrency exchanges and a suite of crypto products on their own websites and in their mobile apps. And I've had the good fortune of being in the crypto space since 2019, where I previously was at Coinbase. And I always tease people that are in the crypto economy or in crypto markets not to hold it against me that I have about 16 years of traditional financial services work as an attorney, but don't hold it against me when I jumped over into the wild world of crypto.
So thank you, everyone. And let's, it's all over the news, crypto. Crypto prices are hogging the headlines today. However, very few understand what are cryptocurrencies. The world of crypto can be very confusing with all the acronyms and other unfamiliar words. So let's just start with the basics. What is cryptocurrency and where did it come from? Deb, can you kick us off, please?
Certainly. When I think about the economy, before we jump in and talk about blockchain and before we talk about cryptocurrency itself, I think it's important to think about the industry itself and how young it is and its potential that it has. I think that's the best starting point. And first, sort of thinking about the industry, it's really important to remember that it's young. And the way I try to explain this to people is think about the internet. Right? When the internet came out, it was this giant typewriter that sat on your desktop and you plugged it into your phone jack and it got mail. It really didn't do a lot, but it started to solve its problems, right? Google came out, for example, and organized data so it was searchable, right? It just solved its problems. Well, that's where we're at. We're a really young industry and we have to take the time to solve our problems. And we're already starting to see that, right? You're seeing different ways that energy is used to mine Bitcoin, which we hear about in the news, or we're hearing all sorts of ways that the economy is regulating itself. So we just need to solve some of our problems in order to be really mainstreamed as an industry. I think second, it's important to think about the potentials, right? And there's three that I really highlight. First, think of it this way. Here in the United States, we're spoiled. We have a really developed financial services system. A lot of countries don't have that. If you think about the fact that 40% of the world's population still today doesn't have access to a crypto economy, but 80% has access to a smartphone. Imagine if your phone became a decentralized banking system that gave crypto economic freedom to everybody around the world. And I think the second thing I would talk about is remittance, right? Today, if I want to send $50 to my mom in Mexico, by the time she gets it, when it goes to the processors in the US, FX, exchanges in Mexico, it's worth about $40 and it takes a long time to get there. But with the crypto economy, you can send a remittance pennies on the dollar over in a second. Right. And then finally, I think about a great potential that you see in the real world is think about hyperinflation like Venezuela, right? Where Venezuela at one point had like 1,000,000% inflation. If you had $100,000 in Venezuela, you effectively went bankrupt overnight. But if you think about the crypto economy, there's something, and I'll use buzzwords as we talk, but it's called tokenomics. But by its protocol, if you can limit supply on an asset, you can actually make it inflationary resistant. And that's what we think of as Bitcoin. Bitcoin has limited supply. So before we jump into Glynna as the SME on blockchain, think about this as a young industry and think of all the potential it has once we solve our problems. So I think Glynna, you got to start us off with some blockchain conversation.
I'm glad that you mentioned buzzwords because that is, I think one of the hallmarks of this industry is that there's so much jargon and buzzwords, and that adds to the confusion, right? Same thing with if you're just focusing on blockchain, there's a ton of buzzwords. So, when people refer to crypto now, it can mean a whole host of things. Different types of digital assets like NFTs. I have a client that's doing securitized infrastructure loans that are going to be tokenized. So it can be digital currency, cryptocurrency, like you hear all sorts of names. And sometimes they just say crypto, and then you don't know what they're talking about. Do they really mean an NFT? So you really want to understand what somebody's talking about when they're talking about crypto. And at the end of the day, all of it is based on blockchain technology. You don't really have crypto or any other forms of digital assets unless you've got blockchain. And we talked in a prior session about kind of a blockchain 101, so I don't want to get too deep in the weeds on it. And we're going to really focus today on cryptocurrency as opposed to like NFTs. But cryptocurrency, like other forms of digital assets, exists on a blockchain as a specific transaction. So if you recall, blockchain is a shared database, right? There are, depending on the size of the blockchain, lots of computers that have specialized software that store information, and they do it in a particular way based on algorithms. So the information is updated essentially simultaneously. And one of the best uses for that is as a ledger, as a financial transactions ledger, to be able to say, I, Glynna, am going to sell Lisa 1 Bitcoin on X day. And using the blockchain, you can take that information, store it using cryptography so it can't be hacked, and then continue to build on that whenever Lisa then wants to turn around and sell that Bitcoin. So blockchain is what really enables that. And remembering when somebody's talking about crypto, whatever type of crypto it is, that it's fundamentally based on some kind of blockchain is particularly important. Deb mentioned that it's a really new industry, and she's totally right. Bitcoin has only been around for less than 15 years, which means blockchain technology has also been around for less than 15 years. But we're already seeing it really transform the financial services industry. So you may have heard of CeFi and DeFi. CeFi is really shorthand for centralized finance. And if you think about your retail banking now, you go to Bank of America, Chase, whoever, and you open your account, get a credit card. CeFi is very much the crypto form of retail banking. You can borrow in crypto, get interest in crypto, use your credit card to pay in crypto. One important difference, unlike retail banking, though, is it's not FDIC insured. But that's what CeFi is when you hear somebody talk about CeFi. And then quickly, DeFi is decentralized finance. It's doing financial transactions without a central bank, without being able to really go bypass banks. And that's really the key to unlocking all of the potential that Deb talked about earlier, is really where we're trying to get. And all of that is enabled through blockchains. And if you remember from our prior session, we talked about the fact that there's not just one blockchain. Bitcoin was the first, but Ethereum is another very popular blockchain. And there are lots of blockchains for different types of crypto and assets. And it's important to remember that, because in order to really get to DeFi, where you can really interchange seamlessly, you need to have bridges across all of those different blockchains. So that's also important to understand sort of how crypto is going to work and how we can move to full DeFi. So Lisa, I'm going to turn it back to you. Hopefully that was helpful in understanding the basics.
No, that was fantastic. And as you mentioned, Bitcoin is the original currency. However, there are thousands of others. The two most well-known cryptocurrencies are Bitcoin and Ethereum's Ether. Bitcoin was founded in 2009. It was the first cryptocurrency, and it's still the most commonly traded. It's what you hear in the news every moment, every day. The currency was developed by Satoshi Nakamoto, which widely is believed to be a pseudonym for either an individual or group of people whose precise identity still remains unknown. Like, people don't know who's this genius is who really sort of, developed this, the whole concept of Bitcoin on the blockchain. And the second most popular and well-known is Ether. It's the native cryptocurrency of the Ethereum blockchain platform, which was conceived in 2013 by programmer Vitalik Buterin. Among cryptocurrencies, Ether is second only to Bitcoin in market capitalization. Given that there are thousands of cryptocurrencies, Deb, can you sort of talk about what are some of these other cryptocurrencies and how are they different?
So it's surprisingly, there are a lot of cryptocurrencies. Cryptocurrency fundamentally or generally is considered a digital token or a coin and that has a store of value. That's what cryptocurrency is. And when we think about cryptocurrency in the space, we kind of bucket it into a couple of categories. So first, obviously, as you guys already talked about, there's Bitcoin. Bitcoin is, before I get started, there are probably, I think the estimate was in early 2022 to be about 18,000 cryptocurrencies in existence. That's a lot. It's not just Bitcoin. It's a really big industry. Most of those you probably won't ever hear about. They won't become popular. They don't have a large market cap or trading volume, but there are a lot of them that are very, very popular. So now let's bucket them, right? So you have Bitcoin that we heard about. That has the highest market cap. It has the largest trading volume and most popular. That's BTC if you go to trade it. Then you have Ethereum. Ethereum is really thought of as the chain that creates or enables DeFi, financial decentralized services that Glynna was previously talking about. Lots of different assets are built off of the Ethereum blockchain, but if you want to go and trade it, it's ETH. That's the second most common. And then we have this other giant bucket, and we generally label these under this term altcoins or alternative coins. And the reason the rest fall in that bucket is most of them were forked off of either Bitcoin or Ethereum, meaning that there's some resemblance coming down the chain. It's important when you think about cryptocurrencies, and you're going to hear us use these words throughout the discussion today, that we think about stable coins, right? Now, stable coins really are a class of cryptocurrency that attempted to enable investors to buy an asset that doesn't have a lot of volatility, right? And it's really important in developing a crypto economy to have some stable coins just by their word. So for example, you guys might have heard this in the past where people talk about there was that person that bought a slice of pizza for a Bitcoin 10 years ago. And gosh darn it, that was a $20,000 slice of pizza today. So if they had a stable coin, they would have bought that piece of pizza and they would have just paid what the dollar was worth. So for example, let's give you the two categories of stable coins. First, there's fiat-backed stable coin. And it's really important to remember the two. So if you go out and buy a stable coin, you want to know what you're buying. If it's fiat-backed, like USDC or Tether, what is happening is some company or part of a consortium will take a USD dollar out of supply and they'll put it in treasury, and they basically mint a USDC or a stable coin. And then they can take that dollar back out of treasury, put it back in circulation, and they burn the USDC. So that's when you think of fiat-backed stablecoin, it's actually backed by a US dollar. Then there's another kind of stablecoin, which is an algorithmic stablecoin. And these are stablecoins that are pegged to the value of a US dollar. And that's either done by some form of collateral or by managing the supply. And be careful, keep your eye up on what you're getting, because if you're buying an algorithmic stablecoin, if there's something called depegging, it can fall off the value versus a fiat-backed stablecoin. And again, the purpose of these are you're more likely to buy that cup of coffee if you don't think that you're investing in it, right? You're going to spend $1, but you might not spend that gold. So that's the nature of a stablecoin. They'll be regulated differently, and we'll talk about that a little later. But keep in mind these buckets and categories of cryptocurrency.
Thank you.
Lisa, that answers the question.
That answers the questions fabulously. Thank you. So if you're interested in buying cryptocurrency, you will need at least one digital wallet to hold this cryptocurrency. There are now hundreds of digital wallets available. Glynna, what are the well-established digital wallets and how do they work?
Well, I think it's first maybe helpful to understand that if you want to think about it as an analogy to cash, if you have cash, you can stick it in your pocket. You can stick it in your wallet and put it in your purse. You can put it under your mattress. You can kind of do whatever you want to with it, or you can give it to a bank, right? And the bank can hold it for you, and you can put it in a deposit account, and then you can move around and do things with it like that. It's similar in terms of crypto. You can go to a third-party provider, and they will hold your crypto for you. Those are called hosted wallets. Or you can have a wallet yourself where you hold onto the crypto and you get to decide what you're doing with it. I think probably one of the biggest differences there is if you use a third party, that person is responsible for managing your key. So whenever you're getting crypto, you've got to have a very long, secure key, because this is all encrypted, right? In order to be able to unlock it and be able to transact on the blockchain with it. The cryptography is key to all of this. I don't know about you, but there are some days I can barely remember my name. I am certainly not going to remember a really very long key. Like it's longer than any computer password that you put in. So one of the benefits of using a hosted wallet is they take care of that for you. You don't have to worry about losing it. We've all heard stories in the news where people have lost their key, they've lost their password, and then they lose their crypto. That's because they were keeping the wallet themselves. So that's one of the big differences. You need to decide, do you want to keep it yourself and make sure you don't ever lose your key? Or do you want to give it to a third party and let that manage that for you? Some of the third parties that are really common are like Coinbase, Crypto.com, FTX, and Binance. There's been a little bit of news on the hosted wallet side lately around Coinbase because they updated their SEC disclosures to say if we're storing your cryptocurrency and we go bankrupt, that might end up being considered our property, and you could lose it that way. In a bankruptcy scenario. That's really not settled yet, not clear. That might be a possibility. There are arguments not, but it's not clear yet. So that's another thing to throw in the mix when you're thinking about a wallet, and how you want to use it. But the one thing also to remember along those lines is if you're using a third party like a Coinbase, like a crypto.com, they'll remember your key for you, but they are not FDIC insured like a Bank of America or a Chase Bank or a regular bank.
Thank you. That was super helpful. Super helpful. So crypto exchanges, are often used as an intermediary between a buyer and a seller, making money through the spread in their transaction fees. You can buy, sell, or trade your cryptocurrencies for other cryptocurrencies, or even for the US dollar through these crypto exchanges. In an effort to increase awareness and encourage the buying and selling of cryptocurrencies, some of the big name crypto exchanges such as Coinbase, Crypto.com, and FTX have become, some of the biggest sports sponsors, especially in the US, where, as I previously mentioned, over billions and billions of dollars were spent in 2021 alone in sports sponsorship. So these crypto exchanges now become sort of part of the norm. You've seen them if you were watching the NBA finals, all over every court, in big bold letters. But as they become part of our vernaculars, people still don't understand what is a crypto exchange and how does it work. Deb, can you sort of explain to us, and walk us through how these crypto exchanges work, please?
Yeah. First, I think it's important to remember these days that there's two types of exchanges now. There's decentralized and centralized. Decentralized exchange, you guys may have heard of the word Uniswap. Uniswap is a type of exchange where it's decentralized, you're trading on the blockchain. And then there's centralized exchanges, and what you were just naming, these are the list of centralized exchanges. Surprisingly, they work like every other exchange that you might know. You want to go buy a share of American Express stock, you go to an exchange. For example, you can go to a Robinhood and buy that share, or you can trade it on an order book at a more advanced trading platform. Very similar exchanges. Well, cryptocurrency is done very much the same way. It's a marketplace, for example, Binance, FTX, Coinbase, where Wire, my own company, we're actually an exchange. We're an exchange that you can build on your own websites or apps, but it's an exchange where you can go create an account, and then you can buy, sell, speculate, store cryptocurrency. There are some that are a lot more advanced, and I think that the bigger names that Lisa just mentioned, they're going to enable you to do advanced trading. So for example, you can go to an exchange and just say, I want to buy an asset, or I want to trade my ETH for BTC, and they'll enable you to do that. Or you can go to an advanced trading platform where they'll actually show you the order book, and they're going to match buyers and sellers, where you meet in the middle, and that's when you make your trade. The advanced ones let you do margin trading. So it's very much like you see today in the traditional markets. I think for the crowd, I would just point out two fees that you want to be aware of. One is obviously you're going to pay a transaction fee, but something else you see these exchanges charging, similar to the traditional markets, is something we call spread. If you're not familiar with that, fundamentally, it's just the markup in the asset. So for example, if I am going to go to an exchange and I'm not trading on an order book, I'm just going to trade with the exchange, I'm going to buy Bitcoin, they're going to quote you a price. And in that price is a little bit of a markup for what they're paying for it. Right. So if you're looking at exchanges and you want to compare them, you want to compare their liquidity. The liquidity helps keep prices down, how much people are acting on the exchange, and you want to compare how much they're going to mark it up. And what you end up seeing is if you go to three exchanges at the exact same point in time, you'll actually see three different prices. And that's because they each have different sets of liquidity and they have different spread. So when you're doing your research and you're trying to figure out what exchange to use, keep in mind Glynna's points about wallets, if they're going to store it, and how much education they're going to give you, and keep in mind how they're going to get the liquidity and how much they're going to charge you in the spread. Is that helpful, Lisa?
Super helpful. Thank you. Fantastic. So in addition to these crypto exchanges, we're touching upon crypto markets. Crypto prices today are all over the news, especially given the volatility. We have seen Bitcoin skyrocket to an all-time high of over 64,000 in the first half of 2021, then just as quickly fall back to below 30,000 last summer. Bitcoin hit another all-time high over 68,000 this past November, but then this past week it dropped below 20,000. And as of this morning, it was roughly 20,435. We've also have seen Ether hit an all-time high at 4,800 late last year. And at the beginning of this year, it went down again to about 3,000. This past week, crazily, it dropped below 1,000. And as of this morning, it's slightly above at 1,088. This recent volatility is re-raising concerns about cryptocurrencies, especially since the combined value of cryptocurrency market has fallen about 70% since its high in November 2021. Additionally, many people are now getting paid in cryptocurrencies, but given the volatility, do you still feel comfortable? Now, on one hand, the argument is you can quickly convert cryptocurrency instantly into a US dollar, similar how you can instantly get paid in sort of the euro and translate it and convert it quickly into a US dollar. But, do you really want to sort of bet on yourself? You've seen athletes take cryptocurrency in payments. That's been a new trend because they believe like, if you're going to give me, $500 worth of US dollars, if you give it to me in crypto, I may want to convert 4,000, then bet on myself that and on the whatever crypto they're getting paid in, that it's going to go up. So then I have a potential of even making more than that $5,000. So given all this everything being so flexible, Deb, what are your thoughts about what's happening in the market, especially with the volatility? And then, everybody's talks about the concerns.
So I think what we're seeing in the markets today is really reflective of what's happening in the wider global markets, right? If you think about cryptocurrency and the idea that it's a security or a commodity, it's going to react the same way any other market is reacting. We're seeing this not just in the crypto economy, but all of the markets, right? And I think you have to keep in mind with hyperinflation, with interest rates rising, with recession looming, people aren't just pulling their money out of the markets, right? I think that what we're seeing now, recently you heard S&P 500 say that they're actually in a bear market now, which has a specific meaning. What we're calling this in our industry would be a crypto winter, right? And it's just a shrinking of the market, right? It's the volatility that you're seeing is the result of everything else that's going on in the global climate. I do think that, although we see markets have natural corrections, something that we're seeing that's unique in the cryptocurrency markets is when you think about fiat or other currency, it's backed by a government. When you think about cryptocurrency, it's not, right? So it's really a result of supply and demand. And when you see shrinking demand, right, more people are selling than buying because of the concerns about inflation, about recession, about interest rates. People are pulling their cash back. So you're seeing a lot of volatility. You're seeing a lot of the value of the assets fall. That's just a reflection of the markets. When you think about how you want to invest or how you want to participate in the market, I would share that. Think about cryptocurrencies as they are in fact either treated as securities or commodities, right? Based on what we call their utility, right? And when you think about that, you want to ask yourself, for example, cryptocurrencies that are deemed securities are regulated by the SEC. The SEC is constantly evaluating assets to see whether or not they need to be traded through broker dealers to make sure that consumers are protected. Commodities like Bitcoin are regulated by the CFTC. A great example is, they think about Bitcoin, it's deemed a commodity. It is a commodity. It's frequently thought of as the gold standard. And the reason you think about that is, I mentioned earlier, it's called recession resistant, just like gold would be, right? And that there's a finite supply. So when you think about what you're going to do with your money, what assets you're going to invest in, whether it's stock, or whether it's cryptocurrency, think about its utility, think about its market cap, think about its trading volume before you make a decision. It's really important, just like you would in the traditional securities markets, that you do your research. Think of this as securities, commodities, it's a speculative market. So just be careful how you're holding those assets.
So Deb, you're touching upon regulations. There's an assumption in the market that, cryptocurrencies have no regulations. So, everyone believes crypto is truly the Wild West. There are no laws that protect you. There's nothing that governs. So can you talk a little bit more about that? Because I think it's important for people to have an understanding that, yes, there are certain laws that govern it. And this, I think, will help build trust in people's belief in cryptocurrency.
I had to laugh at that. I am a regulatory attorney, and I've been in the space for a long time. And as I mentioned beforehand, in traditional financial services, and I can promise you it's well regulated. So I think the way I would describe it is, yes, in our space, we're, again, a young industry, and we need to find a way to build trust in the economy, in the crypto economy. And there's two ways that we're doing that. First, there's this thing called personal liability that scares people about the space. So Glynna touched on it earlier, the ease of which you lose assets. And I think, Lisa, you pointed out, all these different exchanges and how organized they're becoming. So one area that you're building trust is through the exchanges, right? Instead of self-custodying and being afraid of that personal liability and losing your key, you can rely on these exchanges that we were discussing. And these exchanges also give you lots of educational material. I would highly recommend you go to FTX, go to Coinbase.com, go to Crypto.com, and go to their educational resource centers. They'll tell you how to trade. They give you tons of information about the assets. So that's one way of building trust. But the other way is regulation. And I'm a believer, don't hold it against me for those of you that are really kind of mainstream crypto, but I'm a believer in reasonable regulation that doesn't stifle innovation. Now, what does this mean? Right? That's the challenge. I'm just going to rattle through some areas of regulation just so people understand how heavily it's regulated. Let's start in the US. So if I am not a bank, but I'm in financial services, I'm helping with payments or custodying fiat, I have to be licensed by the state. Each state has what they call money transmitter licensing requirements and regulations. So if a company is going to do payments or it's going to manage fiat, it's going to get its MTLs. In the United States, 22 of those state MTLs already cover cryptocurrency, and more than 50% of them cover fiat-backed stablecoin, where they treat fiat-backed stablecoin as e-money.
So before you go ahead, if you could just explain what MTL is in case people aren't familiar with that.
An MTL is a money transmitter license, and basically it's the license an entity needs to get. And they go through annual exams by every state. They have to maintain certain capitalization. They have to hold your assets in trust and in custody for you to protect you. They can't use it for their own purposes until you take it back. And it's heavily regulated. Every company that wants to transact in fiat services in the United States in payments or custody has to get a license this way. It has to be regulated and demonstrate their info security systems, their capitalization, their ability to meet and return your assets to you, their ability to ledger it, and their ability to comply with all of the regulations that come with it. So that effectively that's MTL. But like I said, those regulations are already covering cryptocurrency across the United States, and that continues to grow. More and more of those MTL licenses are covering crypto assets. Then let's think about the EU as another great example. So in the EU, if I have fiat-backed stablecoin issued in the EU, that is going to be treated like money. It's called e-money, and it's going to be regulated the same way fiat's regulated under what they call an EMI license. And then if you have digital assets, cryptocurrency, that's regulated by what we call a VASP, a virtual asset service provider license. So if for example, my company, we want to offer exchange services in the EU, we have a VASP license. Thinking about another big area that scares people is AML, FinCEN, all the bad actors that are out there, right? And I'm going to give you guys some things to write down. I think you'll find this entertaining. So Lisa and Glynna already explained that transactions occur on the blockchain. That means they're visible. Everybody can see them. If you go to something called Etherscan, ETHERSCAN, Google it. If you go there, you can see every transaction that's occurring on the Ethereum blockchain. It's visible, you can see it. And then something else that happens is there's a company out there, for example, called Chainalysis. Now, Chainalysis uses AI and intelligence software, and they work with government agencies to track bad actors so they can actually monitor all the public transactions because they're public, and they can use all this artificial intelligence to see if it's tagged to a bad actor. So these are regulated spaces. This is not the wild, wild west that we have. Bitcoin came out 15 years ago. It's heavily regulated. Something else I think is really interesting that people should keep in mind, a goal, again, with the goal of all of our regulators trying to build trust in the system, is where we're heading. So the Biden administration already came out with requests for comments on some new regulations that we'll start to see in front of Congress at the first session next year. And in the EU, we have something called MiCA. MiCA stands for Markets in Crypto Assets. And the EU is trying to kind of enable a collective legislation that will apply to all the bloc members of the EU to regulate the space. So it is heavily regulated. I think the bigger challenge is it's regulated under so many different frameworks that the goal coming with the Biden and with MiCA is to kind of create more uniform regulation over it. But hopefully by building trust, we'll continue to come up with better regulations that enable this innovation.
Thank you. That's super, super helpful. So the security of cryptocurrencies is also a hot topic. Are cryptocurrencies secure? And I think, you know, how we've discussed it, it's best to sort of pull it apart and answer it in two separate questions. First, is the blockchain that the cryptocurrency is part of secure? And second, is my digital wallet where I'm storing my cryptocurrency secure? Deb, what are your thoughts about the first question? Is the blockchain secure?
Yes, the blockchain is secure. I think Glynna said it best when she talked about it being a public ledger. So basically, cryptocurrency is built on blockchain technology, as she discussed, and blockchain technology is built on something that we warned you up front that there would be lots of buzzwords, so here's going to be a bunch. So blockchain technology is built on what we call the trilemma. The trilemma stands for three pillars that all blockchain technology is trying to balance, right? There's scalability, there's security, and there's decentralization. And when you think about what the goals are of blockchain, it's to balance these three pillars in the trilemma. You know, it's the easy way to think about it. If something is decentralized and really scalable, there's this thought that it's probably not that secure, right? And if it's super secure, it's probably not that scalable. So how do you balance the three in the trilemma? Ethereum is actually the blockchain that's considered by most to be the most balanced. It's found a way to balance these three pillars. So it's both scalable, decentralized, and secure. So that's one bucket of how you think about the blockchain and its security. The other buzzword to keep in mind is something that we call consensus. Consensus is basically the mechanism for validating a transaction on the blockchain, right? So for example, you've heard these terms, proof of stake, proof of work, proof of history. What this basically means is if I want to give Glynna or Lisa a Bitcoin, so I'm going to give each of them $20,000 worth of Bitcoin, congratulations. So when I take my Bitcoin and I send it to them, somebody's got to go through, or a validator, a miner will go through, and they'll perform a validation exercise called consensus. They're going to prove that I have it and it's mine and I'm allowed to give it to Glynna, and they're going to enable that transaction so that I don't spend it twice. They don't want me to give the same Bitcoin to both Glynna and Lisa at the same time, because if I only have one Bitcoin, it won't work. So that's really why the trilemma and consensus work together to ensure that we're securing the blockchain. I think before I pass it on to that second question you raised about really the platforms being secure, is to remind people of how you pay for proof of work, because everybody has to pay the fees, right? So proof of work, proof of stake, whatever validation mechanism you're using, you're going to pay what's called gas, right? Now, gas.
You get into sort of, just sorry to interrupt, into gas. Can you just explain to the group what is proof of work and proof of stake, just in case everybody in the audience is not familiar with those terms? Another buzzword.
Yeah, you know what? It's so proof of work, proof of stake. Those are the validating mechanisms. Those are the mechanisms to validate a transaction. They come up with different ways to do it. So for example, it used to be with Bitcoin, we had miners. And what would happen is groups of miners would take all this technology and they would just churn out and churn out. You hear these stories about giant warehouses of databases and computers that are just sucking up energy and churning out transactions, chasing down transactions. What they're basically doing, to put it simply, is running up the block to find out where your transaction was, to validate you have the Bitcoin, and then they're building a new block when you transfer it to Glynna or to Lisa. That way, they can always monitor the transactions on the blockchain. But imagine if there's gazillion transactions on a blockchain, there's a lot of mining that's going on to chase up the chain to find when you bought that crypto. Well, proof of stake, for example, or proof of work, these are new mechanisms where, for example, they may just have you put up a bunch of money. So when you go in and you think you validated a transaction, if you're wrong, you have to pay for it. They're going to pull some money out. So it takes less energy. So proof of history is just that. It's basically proving up history of the chain as opposed to mining. So these are just different mechanisms for validating a transaction. Does that answer the question or add some clarity, Lisa, before I jump into gas?
Thank you. Thank you. Now we're ready for gas.
You're testing my knowledge base here. I'm getting a little nervous.
You're doing fabulously, so thank you.
Okay, hopefully I'm making it pretty simple to understand. Gas is something that, and I always compare it to like Uber gas prices, right? It's surge pricing. So gas is what you're going to pay for that transaction. It's what you're going to pay that person or that company for proving your transaction. And what this means is first you pay, it's broken into two parts. First you pay like your base gas fee. And this really depends on how much activity there is in the blockchain. So if there's lots of transactions going on, it's a really hot market, you're going to pay more gas because it's surge pricing, right? And then there's tip, right? And the tip basically is how quickly you want the transaction to occur. So for example, if you go one of these exchanges like Coinbase and you go to say, I want to transfer a Bitcoin, I'll give it to Lisa this time. I don't have to. So Glenn, I'm sorry, you're out of luck. So I'm transferring it to Lisa. I can go in and set my gas fee. I can say, gosh, I need this to get to Lisa immediately. And it's a really busy day for all those miners. So I already have high gas fee. And then I slide my monitor over to the left and I pay tip. And that means it's going to happen. And I cut in front of the line, it's going to go really quick. Or I can slide it all the way over to the right. And that means I can send it by the end of the day. And my gas fees are a lot lower, but it's going to take more time to get there. Now, remember, if you slide it all the way over because you don't want to pay a lot of gas, by the time that crypto asset moves, due to volatility, it may have gone down in value or up in value. So the amount you're transacting may not be what you intended.
You know, I think that's a really good point to notice a difference in typical financial transactions too with retail banks, because it happens almost instantaneously and you don't have any control over the fees you're paying, right? So here you can set the fees, but it's going to maybe make your transaction take more or less time, which is a level of control you don't have otherwise.
But how does that apply to the crypto exchanges? Aren't often crypto exchanges you can sort of convert it rather quickly?
Most crypto exchanges actually set the transaction at an average. So you're paying average. They're called network fees. So if you go and look at the fees that are spelled out for you in a transaction, you're going to pay your transaction fee and your network fee. And remember that hidden, sometimes not visible fee spread. But the network fee is basically the gas. And it's very often when you see network fee, there'll be a little tooltip there. When you click on it, it will enable you to set the speed at which the transaction will occur. Not all exchanges will do it. So if you're interested, most set at the average speed, but if you're interested in the timing of your transaction, find an exchange that enables you to set the time.
Thank you. That's super, super helpful. Super helpful. So now we've talked about whether the blockchain is secure and how the blockchain works with regards to these fees and gas. Now let's get back to sort of, we're talking about the security of cryptocurrency, the security of your digital wallet. And it all depends on your actual digital wallet. Your digital wallet is like any other software system, and it's subject to certain vulnerabilities, including security. As a result, for security purposes, digital wallets require some form of authentication. Traditionally, digital wallets use the risk-based approach to authentication, such as what you've seen is what we call the two-factor authentication process to make a transaction or access an account. First, for example, you may be asked to enter your username and a password to start the transaction. Then you may have to enter an authentication code sent to you via text to your personal mobile to complete the transaction. This was sort of your traditional way of securing the wallets. Recently, we've become much more advanced, and now we're using cryptographic authentication, also known as key-based authentication for some of these wallets. Cryptographic authentication allows the digital wallets to trust that the data inserted by users during their authentication and verification events is actually true by leveraging cryptography as the source of truth. So think of your phone number, and more specifically, the unique serial number that's found on every SIM card. That is what they're now using to validate that it's you. They really want to prove it's using more advanced technology than the traditional two-phase authentication. While security measures are in place, that does not mean digital wallets are unhackable. For example, if you don't protect your password to your digital wallet, your cryptocurrency being held in that digital wallet would also be vulnerable to be hacked. Additionally, there have been several high dollar hacks that have cost cryptocurrency startups heavily. Glynna, do you want to just highlight a few of these sort of high profile, hacks that have occurred?
Yeah, I think it's interesting to talk about the wallet piece and to also mention the bridges that we talked about earlier, because that's really where a lot of the weak points are. When you think about technology, we're still talking about software servers and databases here, and you want to figure out where the weak points are in the system. As Deb mentioned, the blockchain and the storing of the information across the databases using cryptography and going through all of the validations, that's pretty secure. It's not entirely impossible, but next to impossible to hack that. But thinking about the wallets and the bridges and how all the technology connects in other ways and applications related to that, those are sort of your weak points on it. So one of the biggest and most recent hacks was earlier this year when Ronin was hacked. And Ronin is a blockchain underlying a really popular game, Axie Infinity. And that was about a $600 million hack, which is, I think, the second biggest ever. And Sky Mavis is the operator of the network. And what happened was the keys to the bridge in order to do transfers are what was hacked. And that's not something you can necessarily control. It's not your own wallet, and it wasn't information being stored in the blockchain or on the blockchain, but it was transfers into another blockchain, and the keys to that are what was hacked. Deb mentioned the trilemma earlier, and that's actually part of the issue with this particular blockchain. There was really a lack of decentralization. Again, you've got to figure out where those boundaries are between being centralized and being really secure, like putting it on a data center in your corporate offices versus, having something spread across and then also having security. But in this case, this particular blockchain network was controlled by 9 validators to validate the transactions, but 4 of them were actually controlled by the same entity, Sky Mavis. And then the 5th one, they gave the authority to another person temporarily, and that person didn't cut off their keys. And so that was easily to be hacked. And then at that point, you've got 5 of the 9 nodes and you can hack in. So there was a lack of decentralizations. There were excessive permissions that weren't monitored. And then they just didn't really monitor the network to be able to tell that there were these fraudulent transactions. So it was a little bit of a culmination of multiple failures that allowed things to happen. So it's a good example about, why blockchain itself may be secure, there are weak points in the system. One of the things I think is sort of interesting about that is recently, I think it was in April, the Treasury Department issued sanctions against Lazarus. And if anybody is old enough to remember, Lazarus is the the group that's North Korean backed that had the Sony Pictures hack in 2014. And they are also targeted with doing the WannaCry ransomware attacks in 2017. So you see some repeat offenders in this space. They've moved to new targets, which I just think is a little bit interesting, but they were effective in this case. Deb mentioned chain analysis earlier. Chain analysis is very into this one because they can see the wallet where this is stored, and they're trying to figure out how to get some of the money back, to the original owners. But it hasn't happened yet, so it's interesting.
Thank you. It is very interesting when you think sort of the bad actors are coming back. But this is an exciting space, and you're going to have exciting good, and and there will also be some bad. But I want to thank Glynna and Debra for a fabulous discussion. But I also now want to open it up for some questions from the audience. So if you have any questions, put it in the chat, and I'll sort of pick and choose a few of them in the time remaining. Here's a question, and I'm going to throw it out to both Glynna and Debra. Well, what do you think about companies having chief crypto officers in the future? Will it become a commonplace for every business across industries to be buying and selling goods and services via cryptocurrency? And if so, do they need to be leveraging a third party like Wire?
That's a great question. I would envision, if I think about what a chief, and I'll jump in, Glynna, sorry.
No, this one's for you.
It depends on the business, right? But a chief crypto officer really is going to be your CFO. So I would envision a chief crypto officer really to be, because remember what a cryptocurrency is, right? It's a token or coin that is a store of value, just like fiat is a store of value. And I envisioned that they would roll up in the same space. We see today a lot of really large players, a lot of publicly traded companies putting a lot of their treasury into crypto. Those are all rolling out of their financial services departments or their treasuries. That being said, I do think that there's going to be a real requirement that treasuries and the CFOs of a lot of these companies to really have somebody that's an expert in cryptocurrency, particularly as we start to see the economy, the crypto economy evolve. Glynna, what do you think?
I totally agree with that. I think there will need to be members of the CFO team who are specialists in crypto.
Yeah,
sure. And maybe they'll have a chief crypto title off because everybody needs a cool hip title nowadays. But you'll definitely need specialists.
I want that role. Someplace else you'll start to see a lot of expertise in the area, and there may be some sort of chief crypto officer. Is going to be in the payment processing sector. We're already starting to see a lot of news about MasterCard, for example, a lot of these companies accepting cryptocurrency for payment of their cards, and they're enabling their networks to be used for crypto transactions. So I think you'll start to see somebody that would fill that role more on the use of the crypto than in a CFO capacity.
I think I completely agree with that. I think you've now seen more and more sort of jobs being posted, people sort of looking, because, especially in some of traditional banks, they know they need to start learning, and it's that FOMO, fear of missing out. And I think people are now starting to sort of no longer poo-poo crypto as like, it's here to stay. And I hope everyone from this discussion, gets that feeling across, like, cryptocurrency is a young industry and it's going to continue to grow. And it can also be grow simultaneously without, US dollar is not going away. The same way, email didn't get rid of the US Postal Service, cryptocurrency is not getting rid of, your traditional currency. So it's just an exciting thing to sort of welcome. It's great for everyone to have joined here, to listen about this, because we really believe that, cryptocurrency is a fascinating industry, and then it has a long way to go. And, from stable coins to Bitcoin to Ethereum, we're at the beginning of a really exciting time. So I want to turn it back to the fourth floor. Thank you again for having the three of us. We've really enjoyed talking to everyone about, one of our passions, and, we really appreciate it.
Yes, absolutely. What a fantastic discussion this has been. And I do see there's a question that just came into the chat. So should we be buying Bitcoin now while it's low? I think probably the audience would love some insider tips on what coins to be buying today. So I don't know if you guys want to briefly opine on that.
I'm afraid to be giving any sort of investment advice. So this is not investment advice, but I did yesterday I have a Coinbase account. I have a few accounts. I have one with Wire. I jumped in and bought 4 new sets of assets. In December, I started telling all my friends, cash is king, save your cash, because you're going to want to buy a lot of stuff in the second quarter. So I would encourage people, yes, I think that this industry, we're in a crypto winter. And what that means is prices are low, everybody's selling, but demand will come back. Rumor has it, if you look at people and how they think about Bitcoin, is the idea is it will eventually hit $100 because it is deemed a gold standard. And we're running out of supply. Glynna could probably speak best to it. But, as miners mine Bitcoin, it creates the Bitcoin. And like I said, there's a finite supply. So eventually all the Bitcoin that's going to be mined will be mined. So there'll be no more, and you'll just have to buy what's available. But I think right now is a great time to buy. I would encourage you to go and look at things like market capitalization, trading volume, utility. And imagine that right now, if you think about those, they'll kind of tease you towards where things are going to go in the future for that particular asset. And I do think it's a great time to buy. The other thing I would look at is what Glynna mentioned before is DeFi. So there's a lot of tokens that are really taking over the activities that a bank would offer, like they offer lending, trading. These are really an area that the industry is leaning into. So you're going to see a lot of activity in these tokens. Glynna, Lisa, do you want to speak to that?
Good, I'll turn it to you.
No, I agree with Deb. I think if this is an area you're interested in, now is the time to play with it, right? I think it's like with anything, you've got to keep in mind that you may lose whatever you invest in the space, right? This is not even FDIC insured. So, you have to be prepared to lose everything. But given where prices are, there is certainly a lot of opportunity for the upside right now. DeFi is sort of an interesting space. I think we'll eventually get there. And if you find the right company, it could be time to get in early for sure. But you've got to do your research and make sure you're comfortable with the risk.
One thing I would say, you guys, about this, like I said, there's 18,000 tokens. There are a lot of them, and I won't use the word that we describe for them because it's not for public use. But it's a type of coin that really is garbage. So just be careful. These are the ones that pop out. They're around for a year. They're worth 0.00001 cent, and you buy it, and it goes up to 2 cents. You make a bunch of money, but that's because it was so cheap when you bought it. And then people jump out of it really quickly, and those that are left holding the token generally lose all their assets. So just watch out for those low supply, low market cap coins.